Hello, YouTube. Today we're going to be talking about how the S&P is approaching the chop shop, which is below our June low at 36217, or the white number we see over here. But we also have a weekly lower low, lower high, and a violation of the 200 weekly moving average again. The reason why this is the chop shop is because as we look here to the E-mini futures, which is the same thing as the S&P, but trades continuously, basically, what do we have? Well, we are below our 3639 June low, but we are actually forming a higher high, a lower high, or an inside bar, and we did not actually test our 200 weekly moving average here. So as we are between 3570 and 3639 on the ES, this is what I would consider the chop shop. Why? Because both patterns do not confirm the same story. And if both patterns do not confirm the same story, there probably is a reason why. So let's look to a headline we got today from Lael Brainerd. Easing prematurely is a risk, but at some point, risks could become more two-sided. So what she's basically saying is that someone's going to get really hurt. There's definitely going to be a chop shop and a trap being set. The question just is, are we going to keep hiking anyway or easing prematurely? Are we going to keep tightening at the rate we are, or is something going to break? That's really what it comes down to. Is something going to break? If we look at what JP Morgan told us, actually looking to the Fed here first, Fed-led dash for higher interest rates risks world recession, warns top EU diplomat. We talked about this as well, the risk of a deep global recession. So when we keep that in mind, and we know that we have the Fed speakers coming out on Wednesday with their FOMC meeting minutes, but it comes out after ECB President Christine Lagarde is going to speak. We're going to hear about the pulse in Europe, which is where there were a ton of headlines over the weekend, also for Taiwan, also for chips. I don't personally want to talk about that. You guys know what happened. It was not nice. Some certain things got dropped in certain countries, and it all ended up being pretty bad. To tie it all together, JP Morgan's Jamie Dimon tells us that he warns the US is likely to tip into recession in the next 6 to 9 months. That 9 months is so important because that would be where we formed the average peak to trough low from 2000 and 2008, 1.5 years after we started. And he tells us as well that it can go from very mild to quite hard, and a lot will be relying on what happens with the war. So I think to guess is hard. Be prepared. I am hoping for global peace. I am hoping things get better, but guessing's pretty hard right now. I would rather be prepared. So if we keep all of that in mind, and now we look here to what the Russians told us today after this came out, again, at 9:30, the bears and bulls both got a huge test where we're like, oh my God, we're so scared. Market's scared. Time to go down. And we got the headline to support it. We're in extreme fear here. So if the market was so scared, that's why the SPY chart broke. But remembering that a lot of news also broke last weekend, which means that's why ES actually went to a lower low and then recovered. There was a lot of bearish news over the weekend before Monday last week. So what's so important for me is not just the news, but the reaction to the news. And I am saying this because when we look to when ES or the S&P actually printed its low of the day, I'm now going to remove all my lines and actually get us back to normal here because I do need my lines back. Here we go. So if we look here to what happened at the exactly on the hour that this news release went out, we're going to zoom in nice and close here, and then we're going to blow it up to make sure we understand where we are for a backdrop. It was exactly here where the headline came out, right around 11 o'clock hour, right? Boom town. Whoa. From low to high, we rip up 50 points. 47 points. So we have the fear from what Jamie Dimon told us, take us all the way down. And then we had a sharp reversal. And where are we? We're roughly in between 3,600 and 3,650, or what? The midpoint, which means the market isn't sure. Do we go higher based on Russia wants diplomacy, or do we go lower based on what they've actually done? They've tricked us before. So the saying is, fool me once, shame on you. Fool me twice, shame on me. And that is where what Jamie Dimon said, in order to be prepared, is what's really important. And this is so key for me because there's now a lot of similarities as we look here to what is happening in the broader market. So when we now look to our daily chart, I want to focus in on one part here for SPY. Then we'll come back and have a look at QQQ. So looking here to SPY, what we notice that we have this period where we have this false breakout or a bull trap. So bull trap 1, bull trap 2. We're now back here to our 200 weekly, but what's more important are these pockets on a short time frame or the E-mini futures. So we have that same false breakout where we break out, ultimately fail. Here we break out, ultimately fail. What I'm focused on here is the pink box. And we reviewed this on Thursday and also on the Friday stream, I believe also on the weekend. So this is so important because it tells us that we should actually start carving out a short-term bottom here. There's our capitulation low. There's our roughly double bottom, but with a lower low. And that's what we put in right here. Ultimately, we bounce up, test the 50 and the channel before putting in the lower low. So that's what we're kind of doing here. We got our lower low. We're back over the VWAP. Can we actually push up here to the channel? This is going to really matter because headlines are really what's driving the market right now. So I think we're due for a bounce into tomorrow. But am I confident on it? Am I betting on it? Nope. Not betting on it, sir. No, thank you. One more thing I will tell you that is so important for me to watch. Not only the push-pull between what I am calling the chop shop, which again is 35.70 on the yes to 36.40. That's roughly a 70-point range. And guess where we are? Right in the middle again. So we're in the middle of the range from the pump. We're in the middle of the range from support and resistance. But finally, I want to look at this chart here. CL, then we'll look at QQQ to see what the story is telling us. So these are oil futures. You can look at XLE if this confuses you. I just like it because it trades continuously, and this is the pattern I'm watching. It's a mega big bull pattern. This is a cup and handle with a back test and a test of the 50 weekly moving average now. So because we had that huge power up on oil or prices going higher last week when OPEC told us we're going to decrease our production, which means prices go up. And that's why we had that big rip last week. But now, as Russia says, we're open to diplomacy. What does that mean? Well, maybe the oil market's going to go back to normal. That's why we're down by 2%. This pretty much started ticking down right when the headline came out. So if oil keeps going down and S&P keeps going higher, for me, what that signifies is we kind of believe the market is pricing in that we could get some peace, which Jamie Dimon just told us is so important. Are we going to get a shallow recession or the soft landing? Or are we going to get that hard landing going into winter? That's what it really comes down to for me. It is that simple. So I'm watching oil like a hawk. I'm watching the S&P really close. And then finally, we want to look at QQQ. And this one right here is also super important because when we got our first true test of the 200 weekly, which was not actually here, it was over here. What happened? Well, we at least got a dead cat bounce. So now that we're testing that 50 monthly, should we also get a dead cat bounce? We got an initial bounce or a dead cat bounce so far, but we have to take out last week's low. And we have to start making higher highs because there's the same thing happening on QQQ on the weekly, where we note that we have 3 weeks below the 200 weekly so far, and we are below all the lows here. We're below last week's low. We're below the low from the 26th. But NQ did print a lower low, but it's holding on by a whisker. It actually rallied up slightly. So what this means for me is that it's really only ES or 1 out of 4 charts which are still holding up. NQ here, technically lower high, lower low, still below the low from 2 weeks ago as well. So that's pretty much what I wanted to go through today. And the last things I want to wrap up here with are just understanding that the bears are like really motivated right now. We note that there is 64% put flow for orders over $100,000, which are unusual. The market is also in extreme fear, which means people are betting that we're going to get a black dirt breakdown or a dungeon breakdown, opposite of a blue sky breakout. In addition to that, when we look at where people were really positioned on the options chain for today, it's really obvious to me. It's obvious that they were positioned from 362 all the way down to 358. They had every reason and opportunity to take us down today. But for some reason, they managed to close us at 360, which is basically max pain. Option sellers are in control. So if option sellers are in control, what we can do is look to Wednesday and to Friday, which will give us clues. Why? Well, if they're doing a great job at burning the prem or burning the premium, they'll probably keep doing it for the rest of the week, all things being equal. The chart broke, but they were able to protect it. So here we got volume and open interest at we got volume at 360, we got volume at 355, and we got open interest here at 355, which means that's a put spread. Over here on the call side, it's more muted, but 362 to 365. And an at the money put is still worth about $3. So that means that's where we get the 360 to 357. And the 357 is what they are using for protection for the 355, which means they want us to break down. 355 would be a new low of the year on the S&P. By when? By Wednesday the 12th. Yay. So we're seeing that the bears are really piling in, and we know the stakes for Wednesday. We got that FOMC meeting minute come out, and then on Thursday we got CPI. So how are they positioned going into Friday, the 14th? Very similar. We note that they have a 360 to 355 put spread. Calls are here, but it's 360 to 365. So where's max pain? Right where we are right now. So if you want to know more about my weekend thoughts and where exactly the S&P started the week off, where we're likely going to go, but more importantly, what you need to know to be prepared, I would encourage you to watch the video that cues up here in a moment. Otherwise, thank you so much for watching, and I look forward to seeing you tomorrow. Thank you.